Apple is down over 10% from its all-time high that was just 3 weeks ago at 198. Today, it's currently at 178, down almost 2% today. Why? 3 quarters in a row of revenue falling, Mo, correct?
Yeah.
But Warren Buffett still likes the company. He still owns the shares. I think it makes up 45 or 50% of his entire stock portfolio. But is Warren Buffett a buyer at these prices? My guess is no. I've always said that I think Buffett's buying Apple at $140 a share or below, and it hasn't been there in a bit. In the last week, the stock is down 9%. This is a company that we have said before. A friend of ours said this to me once, and I absolutely believe him. I believe Apple will be the last company people give up on. By the time this bull bear market cycle is over and we end up at the bottom of a bear, which a lot of people think happened in October, which I don't agree with, but I think people have to give up on all these layers of companies. And last year and the year before that, it was EV and all these hype, stupid companies like Tattooed Chef, Workhorse, Nikola, which by the way, I think Nikola is up a lot today, but it's going to go down the list. And the last one they'll give up on is Apple. But once they've given up on Apple, that's when I think we've hit the bottom of the market, or we've either hit it or very close to it. And Apple right now is currently selling for 30 times last year's earnings and 35 over the last 5 years. And their earnings aren't exactly increasing like crazy, but they did over $100 billion in the last year in terms of free cash flow. Revenues declined a little bit. So guys on this channel, here's what we're trying to do. We're trying to teach you that when you buy a stock, you're buying a piece of a business. And that takes a little bit of time to wrap your head around. Because once you understand that, you'll understand that if you pay a reasonable price for the stock, for the company, and if the company's financials get better and better, so will you. That is the big key in this world. Because what we see a lot out there is people just attach themselves to the story. And they overpay for that story because they say, look at the story, it's great. And guess what, guys? Story is very important. But back in 2000, tech stocks could do no wrong. The internet was the next big thing. And guess what? They were right. But 98% of dot-coms went bust. Back in early mid-2000s, real estate was a great way to earn money. And they were right. But then the bubble happened and it popped. Yeah. EV was going to change the future of cars. And they were right. But how many have gone under? And Tesla still hasn't hit the peak it was at 2.5 years ago. It's still down 40% from its all-time high 2.5 years ago. But with Apple, you have a great cash flowing business with a great balance sheet. So the question is, what do you want to pay for that? Well, I'm going to jump ahead here, Mo, to something.
Okay.
Let's look at analyst estimates on Apple's revenue growth. Guys, is this amazing? No, it's nothing great. It's very little growth. It's not the growth hype story, but that's okay. You can make a lot of money on companies that aren't growing a ton. That's what I want you to understand when you listen to our channel. Part of your process is to say, listen, whatever the story is, I can assign a value to that story. But the question becomes, are you going to overpay or underpay for that story? And Apple has been an amazing story. Amazing. $100 billion in free cash flow in the last 12 months. That's incredible. But let's go look at the quarter-to-quarter earnings. $81.8 billion last quarter. The same quarter a year ago was $83 billion. So they were down slightly. Last quarter, they did 94.84. The previous year, same quarter, 97.28. Quarter before that, 117. The corresponding 1 year before, 124. 3 quarters in a row. When comparing the year-over-year growth, it was negative. Is Apple dead?
Maybe.
Now, Mo's our Apple aficionado because this has a cost basis on Apple of $17 a share.
I was wondering where you're going with that one.
You didn't know where I was going with that one?
No, I was like, wait, because I was thinking about the last video.
The immense jealousy that I have that you're up over 10 times on your Apple investment.
Yeah. So a lot of the panic right now is that iPhone sales have fallen for a 3rd consecutive quarter.
Yep.
To $39.7 billion from this time last year, $40.7 billion in revenue.
Now remember, guys, I'm going to interject real quick. Don't own the stock just because Mo has it.
Correct.
Do not, but we're here to teach a process. Yeah. You need to do your own research, figure out your own process, and figure out what makes sense to you. Right. Sorry, go ahead, Mo.
Service, however, which I think they're transitioning to more of a service company. Yeah, is $21.2 billion from $19.6.
And the great thing about services, high margin.
Exactly.
Higher margin.
And that department is going to grow so much, the service department.
Has to.
Especially with the stronghold they have on app developers. I just triggered Tim. All right.
By the way, have you seen their adorable dividend? What do you do with your adorable dividend every month?
I think I read that they're increasing it. Let me see here, because my dad sent me this article and he goes, "This is stupid." Now, when my dad's saying that, you know that's probably pretty stupid.
Or it's really smart. He just doesn't get it.
Or it's the opposite. Let me look this up.
So, guys, paying a dividend, we always want to talk about this because people love getting their dividends. I'm active on Twitter and people talk about dividends all day long and blah, blah, blah. Guys, dividends are just taking money out of the company's coffer and putting it in your pocket and charging you an extra tax on it. The tax is already been paid by the corporate level. They're charging you another tax. It's a very tax inefficient way of giving money back to investors. Go ahead, Mo.
So believe it or not, this is the 11th year in a row they've increased this. So what do they start at?
Well, remember,
1 cent?
But what was their market cap 11 years ago?
Yeah, that's true. So they have declared a cash dividend of 24 cents per share, increase of 4%. Also, I want to mention this. They have approved a $90 billion stock buyback program.
$90 billion.
Yeah.
Okay. So they're getting a lot of influence from Warren Buffett. Tim Cook and Warren Buffett are meeting a lot. And Tim Cook has even said, I didn't really understand my job as a capital allocator since I started talking to until I talked to Warren Buffett. Mm-hmm. What does that mean? Because you're probably hearing that going, what the hell does that even mean? We truly believe the true job of a CEO, especially of a mature company, is to properly take the cash that comes in the business and do the best thing with it. There are 5 things you can do with free cash flow. Buy back shares, pay a dividend, pay down debt, make acquisitions, or invest back in yourself, okay? Now, with Apple, making acquisitions, yeah, they're probably going to do that. But what can they possibly acquire that's going to move the needle?
And there's nothing significant that they could do.
It's hard. They have to make some major acquisition.
I mean, look in the last 10 years, the biggest acquisition they've made is $3.1 billion.
That's for the full year.
For the full year.
That's not even a one-time acquisition.
Right.
Which, by the way, I'm glad they're not getting aggressive with acquisitions.
Me too.
Because CEOs...
they're not trying to grow in that way, because usually you would see a company that gets to 3 trillion and be like, okay, we got to keep growing. Let's figure out a way to do this. Let's just go buy things. And we do hear a lot of people say, Apple needs to buy this. Apple needs to buy this. Apple needs to buy this.
Guys, it gets very dangerous when a CEO and a company wants to show how busy they are by making acquisitions. Because guess what? They're usually going to overpay. Mm-hmm. Because their goal is to sit there and say, look what I'm doing for the investors. Okay, well, we prefer they not do that. Second thing, they can invest back in themselves. Okay, what can they possibly invest in right now that's going to move that needle even further? Yeah. Apple's issue right now is it's too big. But that can be okay, because once the market realizes it's too big, then the stock will start to fall, and guess what will happen? The opportunities for this will be huge. Then at that point, when the stock falls more, they should be buying back a ton of shares. When they buy back a lot of shares, they're giving you as the investor a bigger and bigger piece of the company by you just sitting back and relaxing. But you're going to hear something very unpopular right here. I wish they'd get rid of this stupid dividend. There's no reason to pay this dividend. No. The stock's popular. Get rid of this 0.5% dividend and either stockpile it and get ready for the stock to fall and buy back shares at that point, or just pay down debt, because they have a little bit of debt and I don't know why. Why pay interest on this debt?
Right.
It doesn't make any sense to me. What are they possibly making the investments in the future? Now, their gross profit margin is 43.4%. It's pretty clear they've decided they're not going to be their own manufacturer of phones. They outsource that, but they're manufacturing their own chips now. Mm-hmm. Guys, Apple is a great company. Apple will be a great company for a long period of time as long as they allocate their capital properly. And that's what we want to focus on. We want to focus on what price can we pay for Apple that makes sense. So that's how we go to our stock analyzer tool. And by the way, look at our 8 pillars in the company. What are the 2 X's, Mo?
I would assume the valuation metrics.
Yeah, that's it. And they got more free cash flow than earnings, which we love, but everything else is a check mark. So it's something to consider. We just have to wait for the right price. But guess what? It could be the right price at 40 times earnings. It all depends on its ability to grow their earnings over time. And if you look at the analyst estimates, they expect $6 a share this year in profit, growing to $8.30 in the next 4 years. That's not a ton of growth. It's still single-digit growth. Go ahead, Mo.
So something that I saw on Twitter, did not factor in, is, and I like that Tim Cook said this, they mentioned AI for the very first time ever. And
what did he say? It was a great statement.
And what he said was, we are not going to talk about anything until we're ready to bring it to market.
He's like, we've always done this.
Always done that. That's what we're going to do. So, when Apple comes to market with something, they typically make a lot of noise. So who knows what they're bringing as far as the AI? I've never even thought about that factored anything. And I think the big thing here is there's over 2 billion devices in people's hands. For ChatGPT, for all these different things, you need to go and download an app. You need to go to bing.com. You need to do something.
The data they're going to have.
They can just install it right on your phone and it's there.
Yeah, they're going to have amazing, amazing data.
I thought about this during the morning show on Thursday or Friday, whatever it was. And I was like, oh my God, I just thought about this on the fly. This is incredible.
And by the way, it's because they didn't mention it at all.
Yeah. Their biggest tool is this. It's in 2 billion plus people's hands, probably more now.
And our biggest tool is Mo.
Thank you.
Did you like that?
That was 10 out of 10.
I think a lot of people out there would disagree with that, though. I think watching the video, people would say, yeah, Paul, that's not Mo. It's you. So guys, this is our stock analyzer tool. Used over 2 million times since we started it. It's incredible. It's one of our many tools, as you see in our software. So again, go to everythingmoney.com. It's a little over $1 a day. Check it out. It's a no-brainer. We're having a rewards program coming out soon where you can actually get less charged per month based on how much you use it. It's an incredible community of thousands of investors that you can sit there and talk to. Thousands of messages are exchanged. It's an incredible thing. So everythingmoney.com, check it out. But our stock analyzer tool, I'm going to pull up the last time I did Apple, which was on Friday. So here's our history. I'm going to pull it up. Now, we did a 10-year analysis, and here are all of our assumptions. As you can see, first off, revenue, ROIC, return on invested capital, is growing over the last 10 years. They're doing a better job of investing the money back in the business. But how much money can they really invest back in the business? That's the hard part about Apple. They're so big. This number just basically says we're a huge effing moat. Yeah. Don't mess with us. You're not going to be able to. If I gave you $3 trillion, I think it'd be hard still to take over Apple.
It would.
To be able to make a phone and all the community, everything that would replace Apple. Yeah. Revenue growth. Look how low our assumptions were. We're like 4, 7, and 10%. Okay, 4% as the world grows GDP-wise. 7% if they're able to do a little bit better with subscriptions, et cetera. And 10% if they really crush it. Even these are big numbers. Profit margin. Very consistent profit margin over the last 10 years. Yeah. We went a little bit lower, 21, 23, and 25. Let's say they crush it and get 25. Same with free cash flow. We went a little bit lower than their 5-year average on our middle numbers, 24, 25 and a half, and 27. Now, for our PE and our price of free cash flow, we went big. Low side of 17, high side of 25, middle side of 21. Why so big? Because of the moat. Yeah. Because of their high return on invested capital, because of their cash flow, because if the stock falls precipitously, they're going to be able to buy back a ton of shares. And that'll really, really be a great increase in the earnings per share. Remember, as they buy back more shares, you as a shareholder will get a bigger and bigger piece of the earnings, which means your earnings that you're going to get per share are going to increase over time. That's why buying back cheap shares is so incredibly valuable to investors. It's so valuable, we're willing to pay a premium for that. Now, finally, our desired return. We're okay making 9% of these low assumptions, but as we go higher in our assumptions, we need more margin of safety. So we did 9% on the low side, 11% in the middle, 13% in the high. Because as these high assumptions occur, it's less likely to happen, so we need more return for that. And we hit the analyze button and look at our numbers. A low side of 90 to 100, high side of 165 to 177. So it's almost on the high side, but middle price of 125 to 135. Keep in mind, guys, my watch list was 120 before we made this video last week. I made it to put it to 125. And I could probably go to 130, 135, but let me wait till it gets there before I do that. So guys, again, thank you for watching the channel. We're here to teach a process. Please check out everythingmoney.com, a little over $1 a day. You're not going to regret it. Every month the price goes up, so sign up now so you lock in your price. Take care.